All right, good afternoon, class. The topic for today that we'll be looking at is bad debts and provision for bad debts. Right, on the board we have a question that we'll be working. So the topic that we're looking at is bad debts and provision for bad debts. Now, what are bad debts? Bad debts, by definitions, are debts that are outstanding by a customer, right? So there are debts that are outstanding by a customer, meaning money owing by a customer, that the company believed that customer would not be able to pay, not today, not tomorrow, or not even in the future, right? So there are debts that the company believed that the customer would not be able to pay anytime, right? So what the company do in return? They write off those debts, right? The company does what? They write off those debts. Right? And to write off those debts, it simply means that they'll be absorbing that as a loss. So it would have been included in their income statement as an expense to the company, right? So if someone owe you some money, after several attempts trying to collect that money, and you would have failed, the fact of the matter is that you would have incurred money, or you would have incurred costs trying to collect that money. So you may very well wish to do what? To write off that debt, right? You may very well wish to write off that debt, right? Take, for example, someone has $500 for you, and every month you'd have to buy a phone card to call that person, right? Now a phone card sells for 100 of what? An average of $150. Right? It therefore means that after 4 months, you would have spent what? $600 trying to collect what? $500. So therefore, accounting allow for you, right? Because you don't want to be penny wise and pound foolish. You don't want to spend more money, which is going to be more costly to the company, to collect less. So in accounting this, they may very well allow you, or you may very well be allowed to write off that amount that is outstanding after you would have proved that you would have tried making an attempt to collect in such, and none of those attempts would have been worthwhile. So you decide to write it off, right? Reason being, you don't want to be penny wise and pound foolish. In so writing it off, it will be written off to your income statement, or what we call our trading profit and loss. Now we've got to be looking at this question and show you how this is done, right? A bad debt is an expense. Bad debts is an expense, right? So bad debts is an expense. Next of which, we'll be looking at provision for bad debts, right? We'll be looking at provision for bad debts, otherwise known as accumulated bad debts, right? Now earlier we would have looked at depreciation and also accumulated depreciation, right? Which, you know, another name for accumulated depreciation is also what? Provision for depreciation. Now why do I bring up this? All provision accounts, right? All provision accounts, so be it provision for bad debts or provision for depreciation, carries a credit balance, right? So all provision account carries a credit balance. All right. Now what is provision for bad debts? They are different, right? Bad debts is different from provision for bad debts. Now what is provision for bad debts? Provision for bad debts is an estimated portion of your debtors. Provision for bad debts is a what? Estimated portion of your debtors that the company believe that their customer or customers will not be able to will not pay in the current year, but rather in years to come, right? So provision for bad debts is an estimated portion of your debtors that the company believe that the customer or customers will not be able to pay in the current year, but rather they'll be able to pay it in years to come. So take, for example, your debtors for the year 2005. Assuming that your debtors for the year 2005 was $500,000, right? Now you know that is the total amount that is outstanding to the company for the year. Now the assumption that you may very well take is that, okay, from that amount that is outstanding, which is $500,000, you estimate that, guess what? 10% of that money, we will not be able to collect it in the year 2005. Right? So you're saying that 10% of that money you will not be able to collect in the year 2005. So what you're saying, realistically, even though 500,000 is outstanding to you, you will only be able to collect what? 450,000. Right? How do you know that? you're assuming that 10% of the 500,000, so 10 over 100 times 500,000 will give you what? 50,000, right? It's going to give you $50,000, right? Now 50,000 minus from the 500,000 will give you what? 450,000, right? It will give you 450,000. So you're saying realistically you expect to collect 450,000 in the year 2005. All right? So you'd have set a provision for that 50,000. Now, how does that benefit the person preparing the accounts, or how does that benefit the company? Right? Provision for bad debts is treated as an expense, meaning that the increased amount in provision for bad debts, whenever provision for bad debts increased, right, it is treated as an expense, meaning that it is written off against your profit. So what you're saying realistically is that to the government of any country, you're saying 500,000 was outstanding to us, right? 500,000 was outstanding to us, but realistically we expect to collect what? 450,000. So therefore we're going to write off 50,000 to get the tax break or the tax exemption on that 50,000. Meaning that we're going to include that 50,000 in our income statement as an expense. Pretty much what we're saying is that we're not collecting that 50,000, so therefore we cannot pay taxes on that 50,000. All right, so we'll make adjustment for our sales because our debtors represent what? Money that customers owe us, right? So what we would have sold to our customer. So what we're saying realistically, we're making adjustment to our debtors figure, which really making adjustments to your sales figure, reducing it by 50,000. So the government would only be able to tax you on 450,000 for that year, right? The government would only be able to tax you on 450,000 for that year. So, in recapping, provision for bad debts is a what? Estimated portion of your debtors that you don't believe you'll be able to do what? Collect in the current year, but rather in what? Years to come. Now, what is the fundamental difference between the bad debts and provision for bad debts? Bad debts are debts that you don't believe you'll be able to collect anytime. Not now, not in the future. Right? So what do? You write it off as a total expense, as a total loss. Whereby provision for bad debts are debts that you believe that you would not be able to collect in the what? Current year, but you'll be able to what? Collect it as the year go by or as the years go by. Meaning that you'll be able to collect it in the future. Right? So that is the fundamental difference. Bad debts are debts that you don't believe you'll be able to collect any at all. So therefore you write it off as being bad. So you absorb it as a total expense, as a total loss. Whereby provision for bad debts are debts that you don't believe you'll be able to collect in the current year, but rather in years to come. So you're saying that, okay, for this year that I don't collect it, I'm not going to pay the tax on it. But next year or future years when I collect it, I'll definitely pay taxation as it relates to it. Reason being because what? The government tax your what? Your profit. The government taxes your profit. Now, to the far right, right, you would have seen some calculation, right? So in our third column, the first column was the years, and the years was what? 1994, 1995, 1996, and 1997. In turn, the second column is speak about what? Bad debts. For 1994, it was 800. 1995, it was 1,000. 1996, it was 1,200. 1997, it was what? 700. The third column speaks to our what? Provision for bad debts, right? And each year, the provision for bad debts in 1994, the provision for bad debts in 1994 was 5%. For 1995, it was 5%. For 1996, it was 10%, and for 1997, it was 5%, right? So that is the estimated portion of your debtors that you don't believe you'll be able to collect for those respective years. Now let us look at the debtors in 1994. 1994 debtors was what? 100,000. For 1995, debtors was what? 130,000. For 1996, it was 100,000. And for 1997, it was 120,000. So you're saying that, okay, each year those would have been your respective sales, right? Those would have been your respective sales. Now remember, the provision was set for their respective years also, right? So when, take for example 1994, when you're saying that debtors is what? 100,000, you would have set a provision for bad debts of what? 5%. So what you're saying, from that 100,000, realistically, 5% of that money you don't expect to collect. Right? You don't expect to collect 5% of that money. Right? So 5% of 100,000 give you what? 5,000. So therefore you're saying that for the year 1994, you only expect to collect what? 95,000. For the year 1994, you only expect to collect 95,000. Now for 1995, your debtors was what? 130,000. And again, your provision for bad debts was 5%. Now 5% of 130,000, right? That gives you what? 6,500. Right? That gives you 6,500. Right? Now in comparison to your previous year when it was 5,000, for the year 1995, it was 6,500. So therefore, 5,000 was set aside from the year before. And this year it is now what? 6,500. So it represents an increase of what? 1,005. Right? It represents an increase of 1,500. For 1996, right? The percentage wise, your provision for bad debts has increased by what? 10%. And your debtors for the year 1996 was what? 100,000. Now when you find 100,000, 10% of 100,000, you get what? 10,000. 10% of 100,000, that is 10 over 100 multiplied by 100,000, that gives you what? 10,000. Right? That gives you 10,000. Now the previous year, which was what? 1995. How much was your provision for bad debts total? 6,005. So it was 6,005 from the year before. Right? And in the year 1996, it's now what? 10,000. So therefore that represents an increase of what? 3,500. Right? That represents an increase of 3,500. That represents an increase of 3,500. Right? Now in the year 1997, your provision for bad debts percentage wise was what? 5%, right? Whereby your debtors for that year was 120,000. Now when you find 5% of that 120,000, what does it equal to? $6,000, right? So 5% of it equal to $6,000. All right. Now the previous year you had what? The previous year you had the previous year you had, for the previous year you had what? $10,000, right? Your provision for bad debts was $10,000. The previous year it was $10,000. So therefore, for 1997, when it is 6,000, it represents a what? Reduction, right? So you had set aside $10,000. Or to date, you would have set aside what? $10,000. Now in 1997, you only require what? $6,000. So that represents a what? A reduction in your provision for bad debts. That would have represented a reduction in your provision for bad debts. All right. What we know of on the board is the bad debts account, right? That is pretty much what the bad debts account will look like, right? So your bad debts account for the year 1994, 95, 96, and 1997. Now remember that bad debts is a what? It's an expense, right? So the first entry that you would have made in the bad debts account, is on the what? The debit side, right? So where you have on the debit side, beneath 1994, December the 31st, debtors $800, that's the first entry, right? And then it is written off to your what? Profit and loss, right? Then you go on the credit side. So the first entry you would have debited, next then you do what? Credit, right? You double line, you balance off, right? So I put the entries on the entry that you do second, or the second entry, I put them in the red, All right, 1995, you realize that the amount of bad debts was what? 1,000. And again, the first entry you're going to what? Debit it, and then you go and what? close it off or write it off to your what? Profit and loss, or what is known as your income statement, right? So the 1,000 on the debit side, which is entered first. Then on the credit side, you put December the 31st also, P&L 1,000, meaning that you're writing it off to your profit and loss. For 1996, the first entry again, you what? Your debit, right? So you have December the 31st, debtors 1,200, right? Then you do what? Credit, 1996 credit now, December the 31st, P&L 1,200 also. 1997, bad debts was what? 700, right? So the first entry, what? You debit it was what? 700. And on the credit side now you put what? December the 31st, P&L 700. All right? And that takes care of the what? Bad debts account. That takes care of your bad debts account. All right. So if we're now looking at the profit and loss extract, right? The profit and loss extract for the year 1994, 95, 96, and 97. This is pretty much how it would look. All right? Now remember the bad debts, right? And we said that the bad debts is what? Written off to your what? Your P&L, right? So it was credited to your P&L, now it's going to be what? Debited to your profit and loss, right? The trading profit and loss that we're talking about now. All right? That we would have sent the notes to you for, right? The trading profit and loss. That would have been our final topic. But these are one of the adjustments, right? So 1994, for the year 1994, you would have just put in what? The bad debts, and the amount was what? $800. For 1995, bad debts, 1,000. For 1996, bad debts, 1,200. And for 1997, bad debts, 700, right? So all you need to do is just take those figures from your bad debts account and insert them in your profit and loss, right? And insert them in your trading profit and loss account, right? That's all you need to do, and that takes care of that. Now we're looking at the provision for bad debts account, right? We're now looking at the provision for bad debts account. And may I remind you, remember that all provision account carries a what? Credit balance. So the first entry that you would make in that account, right? The first entry that you'd make in that account would have been on the credit side, right? And again, be reminded that when we say account have a credit balance, it therefore means that whenever there's a balance brought down, the balance brought down would appear on the credit side, right? All right, let us continue. Provision for bad debts. The first, when we calculate the provision for bad debts for the first year, right, remember that we got what? $5,000. So the first entry there will be recorded on the credit side. So we have what? December the 31st, P&L meaning profit and loss, 5,000. Right? Then what do? We balance it off. Right? So we find the difference between both sides, that is the credit side and the debit side. Right? The credit side at 5,000, so therefore the debit side was short by what? 5,000. So we go over to the debit side and put what? December the 31st, balance CD, 5,000. I would double line. So for the year 1994, both the debit side and the credit side is now the same. Now what do we know? Once you have a balance CD, you must have a what? Balance brought down, right? On the opposite side. So let's go to 1995. In the year 1995, notice what we have on the credit side there. January the 1st, balance brought down what? $5,000. So January the 1st, balance brought down $5,000. Now when we did our calculation, remember the debtors for the year 1995 was what? 130,000. The debtors for the year 1995 was 130,000. And your provision for bad debts was what? 5%. Now when you find 5% of $130,000, what did you get? 6,005. You got 6,005. But remember you had what? You had 5,000 that you set aside already. So all you need more was how much? 1,005. Right? So when your provision for bad debts for the year 1995 was 6,005, but you already set aside what? 5,000, right? I like to look at provision for bad debts as in setting aside money for a rainy day. So if we look at it like this, you already had what? 5,000 that you put down from the year before. Right? Now this year when you required what? 6,005, all you need to find is another what? Additional of what? 1,005. So what do we have there? December the 31st, P&L, 1,005. So that is all we need to take away out of this year profit, 1,005, because we have already set aside 5,000 from the previous year. So you have December the 31st, P&L, 1,005. When you add the two together, you get the what? The 6,005 that is required. Now you balance off. So you go on the debit side and you put what? December the 31st, balance CD, 6,005, right? And you add it up and you double line. Now again, once you have a balance CD, you must have a what? Balance BD. Now your balance CD was on the debit side for 1995, thus giving you for 1996 a balance brought down of what? 6,005. Alright, so you start out with 6,005. Now in the year 1996, your debtors again was what? 100,000, but the percentage meaning that your provision for bad debts was what? 10%. Now when you find 10% of that 100,000, you get a provision for bad debts. You get provision for bad debts of what? 10,000. Now how much did they have put aside from the previous year? 6,005. How much is required for the year 1996? 10,000. But remember you have what? 6,005 that you set aside already. So therefore, for the year 1996, you only need what? 3,500, right? To add to your 6,500 to give you the 10,000 which is required. So you're going to take away what? 3,500 from 1996 profit, right? So 3,500 will be taken from 1996 profit to add to the 6,500 that you had before, right? And that gives you what? $10,000 which is required, right? So you get the $10,000 total on the credit side. Now your balance off. The debit side didn't have anything, so balance CD on the debit side, 10,000, right? So you get both sides now equal. Let us move to 1997. Now you had a what? You had a balance CD. You had a balance CD on the debit side for 1996. So you're going to take it down to 1997, and that gives you what? And that was how much? 10,000. So in 1997 on the credit side, January the 1st balance brought down 10,000. Now something there happened in the year 1997. What you realize happened in the year 1997, right? In the year 1997, your debtors was what? 120,000. But the provision for bad debts was what? 5%. Now when we find 5% of 120,000, right? When we find 5% of 120,000, you're going to get what? 6,000. You will be getting what? 6,000. So 5% of 120,000 give you $6,000. So what do? We had what? 10,000, but how much do we require for the year 1997? 6,000. So does that represent an increase or a decrease? It represents a decrease. So we had 10,000 that we set aside, but we are now required what? 6,000. So because it now represents our reduction, meaning it represents a decrease, right? On the debit side, you'd have to put what it had decreased by. So we had 10,000 and we now required what? 6,000, right? So therefore it's going to reduce by what? 4,000. So notice on the debit side here we have what? December the 31st, again, P&L, 4,000, right? And when we find the net difference, you're going to give us what? December the 31st on the debit side, balance CD of what? 6,000, which is the amount that which is needed, right? Balance CD, 6,000, right? Now, if you were doing the year 1998, of course, on the credit side for 1998, you would have carried down a balance brought down of 6,000, right? You'd have carried down a balance brought down of $6,000, all right? So remember, because it represents a reduction, so it had reduced by 4,000, so that is why we had on the debit side, December the 31st, P&L, 4,000. If we look at the previous year, when it was increasing, we put the amount that it what? Increased by, right? We put the amount that it increased by. In 1995, it increased by 1,500. I put in the 1,500. In 1996, it increased by what? 3,005. We put the 3,005. So when it reduced, right, we have to what? Debit the amount that it reduced by. Right? So when it increased, we credit the amount that it increased by. When it reduced, we debit the amount that it reduced by, right? And that is why we debit $4,000 on the, well, that is why we debit $4,000 in our provision for bad debts account. Now let us turn our attention to the profit and loss extract. Remember that we would have already shown you how you calculate the bad debts. And the bad debts is now inserted. Now we're now putting in the what? The increase in provision for bad debts. So for 1994, increase in provision for bad debts. For 1994, the increase in provision for bad debts was what? 5,000. When you add it to your bad debts, you get a total of what? 5,008 for the year 1994. Just go to 1995, right? The increase in provision for bad debts was what? 2,000. The increase in provision for bad debts for the year 1995. The increase in provision for bad debts for the year 1995, was what? 1,500, right? It was 1,500. So you add that 1,500 to the bad debts that you had before, and that will give you a total of what? 2,005. For 1996, what was the P&L figure coming from your provision for bad debts account for 1996? The P&L figure was what? 3,500, right? 3,500, right? Which represents the increase. So your bad debts before was 1,002. So when you add both of which, you get what? 4,700, right? Because remember in 1996, provision for bad debts had increased by 3,005. Now for 1997, right? Bad debts was what? 700. But remember there was a what? Reduction in provision for bad debts. So it's now going to what? Reduce your expense, and by nature of reducing your expense, you're going to what? Increase your profit, right? You're going to increase your profit. So what do you do? Under the expense, you have what? Reduction in provision for bad debts. How much did it reduce by? 4,000, right? Right? So you got to minus that 4,000, right? Which is the reduction. Now when you minus that 4,000 from the 7,000, you get a negative what? 3,300. So that, right? You get a negative 3,300, right? So that is the impact that it's going to have on your income statement. That's the impact that it's going to have on your income statement, right? Now, of course, it could be treated as in what? What you could have done if you're looking at the expense there. If you're looking at expense, what you could have written is that before you when you write the expense, right, where you're seeing that sign there, what you would have put there is what? Gross profit, right? You would have put your gross profit there, and then beneath your gross profit, you would have had what? Add other revenue, right? You would have add other revenue. Now, because provision for bad debts had reduced, it would have been a revenue for you, right? Meaning that you would have made a savings of what? $4,000. You had $10,000 that you set aside, but you only required what? $6,000 in the year 1997. Right? So therefore you would have had a savings for the year 1997 of $4,000. So, right? So after you write the gross profit, you could have easily write right there, reduction in provision for bad debts, $4,000, right? Reduction in provision for bad debts, $4,000. So it could be treated like that also, okay? Now if you treat it like that in the year 1997, it would not be added to your bad debts to give you that net impact of 3,300. But nevertheless, it's going to provide the same impact. All right, we're now looking at the balance sheet extract, right? I will call these things an extract because it represents a part of the balance sheet, right? It represents a part of the balance sheet. So because it only represents a part of the balance sheet, we say that it's an extract, right? Now remember that the balance sheet starts with your what? Your fixed asset, or what we call our what? Non-current asset, right? Or what we call our non-current asset. So it doesn't start with our current asset. But because we're only looking at the debtors part, and the debtors aspect has to do with the current asset. So we're just representing the current asset part of the balance sheet there. Now for 1994, notice there, we insert the debtors. Or again, the debtors for 1994 was what? 100,000. And whereby your provision for bad debts was what? 5,000. When you minus your 5,000, right, so you have there less provision for bad debts. When you minus the 5,000, from your debtors, you get what? 95,000. Now for the year 1995, your debtors was what? 130,000. And what do? You less the what? PFBD, which is your what? Provision for bad debts. Now remember that your total provision for bad debts, not the increase amount we're talking about now. Your total provision for bad debts is for 1996 was what? For 1995, sorry, it was 6,005. You had 5,000 from the year before, and the increase amount was what? 1,500, so that gives you a total of what? 6,500. Now when you minus the 6,500 from the 130,000, you get what? 123,500. So pretty much what you're saying that Even though you have 130,000 outstanding, you expect to collect what? 123,500 for that year, which is the year 1996. Which is the year 1995, sorry. Now move on to 1996. 1996 our debtors was what? 1996 our debtors is 100,000, right? And our provision for bad debts for the year 1996, meaning that the total for our provision for bad debts is what? 10,000, right? So we had 6,000 before, we had 6,005 before, and it had increased by 3,005, so that is a total of 10,000. So it's a total we put in the balance sheet, whereby we only put the increase or decrease amount in your profit and loss. We put the entire amount to the balance sheet, meaning that the entire amount for that year that it represents for that year. So that is why we put the 10,000 to the balance sheet. 10,000 minus that 100,000 give us what? 90,000. So we're saying realistically, we'd only be able to collect 90,000 for that year, right? Which is the year 1996. 1997, your debtors was what? 120,000, right? And your new provision, right? Your provision for the year 1997 was what? 6,000, right? You required provision for 6,000. So when you minus the 6,000 from your When you minus the 6,000 from the 120, you get what? 114,000. So realistically, you're saying that you'll be collecting 114,000, or you expect to collect 114,000 in the year 1997. That pretty much ends the lesson as it relates to bad debts and provision for bad debts. How bad debts is treated in the bad debts account, in the provision for bad debts account, how it is reflected in your P&L extract, and how it is reflected in your balance sheet extract. If you note that the bad debts is not reflected in your balance sheet, only the provision for bad debts is reflected in your balance sheet, right? So bad debts is not reflected in your balance sheet. But if you're looking at the profit and loss extract, both the bad debts and increase or decrease amount for provision for bad debts is reflected in your profit and loss extract. All right? Okay, there ended the lesson.